Hi, I'm Rod McIver, and this is a brief introduction to the research we do at Risk Research. It's based on two primary elements, I would say. First of all, detailed financial statement trend analysis. That probably will make the most sense to people who've actually run businesses. Um, you can tell a lot about a business from its financial statement trends. It's kind of like a medical checkup where you might get your temperature taken and your blood pressure and blood test. And by looking at the trends in those things over time, it becomes clear whether everything's good or there's a problem somewhere. And what we do is detailed financial statement credit analysis, the same kind of work that has been done by lenders and investors in private companies and public companies for decades. Benjamin Graham and Stanley Dodd, kind of made it hip in the 1950s, if Graham and Dodd can ever be considered hip. But it's grunt work, and so we've developed computer software that can compare each public company to all others, and tell us when it identifies something that's got characteristics that look particularly interesting. And the second part of our work involves buy on weakness. So we're buying improving companies on weakness, and that weakness can be because the market's weak and people are concerned about the economy, or interest rates tick up, or some political event. But we buy on weakness. Sometimes we buy on extreme weakness. Sometimes the stocks we're buying are collapsing, and we get emails from people telling us how foolish we are catching a falling knife, they say. Well, we know the quality, and we've seen these things turn on a dime enough times over the 40 years we've been in the investment markets. So we take the risk that we're buying too soon. And similarly, we're often selling on extreme strength. The market is going up by leaps and bounds, and everybody's convinced that it is going to go up forever, and they can't wait to get in so they don't miss out. And we're selling into that right now. April 26, 2021, we're 83% in cash and waiting for opportunity to knock. All right, let's take a look at the research in action. This is our summary report. We publish this at least weekly, and it is the I'll just scroll through it so you'll see what it is. So these are currently, there are 100 pages to this report, so there's 98 companies, and each company has its own page so that subscribers can easily scroll through and compare each company to all others. The top of the three graphs consist of return on assets and free cash flow. We place a lot more emphasis on free cash flow than we do on GAAP earnings, and we particularly avoid any suggestion or interest whatever in EBITDA. That's like a bad word around here. If you're curious why, just type it into Google: Seth Klarman, Warren Buffett, Charlie Munger. I think Charlie Munger actually refers to EBITDA as bullshit earnings. But anyway, this is designed so that subscribers can easily scroll through all companies. And when they see one that looks like it might be of particular interest, we'll take a look at the number one rated stock and company currently, Quidel, pharmaceutical company that makes diagnostic tests, including for COVID. stock's been very weak lately, which interests us in part because look at how strong the financial statement trends are. So top, as I said, return on assets, free cash flow, middle, financial strength, lower, stock price versus our estimate of intrinsic value. And of particular interest to us, the one we really focus on when we scroll through these reports is the financial strength, which has about 15 different measurements in it: interest coverage by free cash flow, cash in relationship to total liabilities, free cash flow versus total liabilities, equity versus debt, etc. So any company with strong free cash flow that isn't showing strong financial statement trends has got a problem. Right now, Netflix would fall in that category. They are capitalizing content development costs, and so their balance sheet trends are generally weak, although the latest quarter they weren't that bad. They were actually improved, but strong free cash flow and weak balance sheet indicates problems, or potential problems at least. So anyway, let's say a subscriber is curious about a particular company. They click on the company name, and it takes them, I'll try to make this a little smaller, it takes them to a 12-page report that looks at all the different aspects of the company. The summary report, we try to summarize our conclusions in as few words as possible so that people can understand in a few seconds exactly what our conclusions are. And here we have momentum, absolutely crucial. Companies with strong momentum tend to way outperform companies with weak financial statement strength, momentum, and the top graph is an average of revenue and gross profit. The reason why we include gross profit, because most companies for a while at least can generate much higher revenue simply by cutting prices. So this balances those two and removes those companies that are capturing market share simply by underpricing. Okay, so this is the growth chart: revenue, gross profit, operating free cash flow, pre-tax free cash flow. Dividend coverage not applicable with most of these companies. Long-term trends, you see this is a company that kind of drifted along without much to show for it for a lot of years and has really broken out in the last couple of years. And this breakout predates COVID. So it's not because of COVID, it's because, things have started to come together for this company. And then for subscribers interested in specific numbers from financial statements, this looks at revenue, income statement, balance sheet, free cash flow, statement of cash flow. Okay, return on assets, absolutely crucial. Return on assets is the combination of sales divided by assets and sales divided by net profit, or by varying operating profit, gross profit, etc. So it looks at margins, which affect return on assets, and asset turnover. You rarely see a company with very strong trends in both. Typically, improving margins mean declining asset turnover. Here you have that very rare combination. Quality of earnings, we look at operating free cash flow versus debt trend versus capital expenditures. Only the very best companies can grow without capital expenditures and without debt. And here you see significantly declining debt and strong free cash flow and high capital expenditures. But given that debt is declining so much, it's not an issue. I won't go through them all. This is perhaps a quick word on intrinsic value. Most of the companies that we invest in trade at a premium to our estimate of intrinsic value, which is based mostly, but not entirely, on free cash flow. This is a rare company trading at a current discount. You can see that over the years it rarely trades at a discount to intrinsic value, but that discount is pretty significant right now, and it's of particular interest to us. although we don't currently have a position, we have had a position, a profitable position several times over the last year. Okay, so, and then coming down here, this is the summary report again that we started out with. So now we'll take a look at the second part of the research that we do, which is when to buy. And let's see here, where? Okay, here we go. Taking a quick look at SPY. We use a pattern recognition software we developed that has an artificial intelligence component. That is, it self-adjusts, doing back tests in the process of running. Right now, with the roughly 97 companies that are SuperGrowth MultiBaggers that qualify, it updates about every 15 minutes throughout the market when the market's open. And it identifies a pattern or the pattern that's been particularly profitable that repeats over the last 12 months. And you can see here when it started to buy, and notice that it was buying all the way down. So this is not saying that we think the market is going to go up or the stock is going to go up. It's just saying, based on how rapid that decline is, if you look at the prior 12 months, those trades have generally tended to be quite profitable. And so, these are, you can see, was buying down in here, buying, selling, and here's a company, I think I wrote, I know I wrote research on it today, published on Seeking Alpha. This is Hain Celestial, company that produces a bunch of different brands in health food, including Garden of Eden tortilla chips and Celestial Greetings tea, and I think Hain oils. So, and the stock's been weak, so it captures our attention. We're not buyers right now down unless it declines down to the 37.88 level, and I think that right now it's trading around 42.16, is it? I think something like that. Anyway, so it's a company we're following closely. New management a couple of years ago. Before that, an activist investor assumed practical control of the board and put in people with lots of successful experience in the food industry, and they've completely, I wouldn't say turned around, but had a dramatic positive impact on the company's financial statement trends. Just became free cash flow positive. That inflection point where a company's stock goes, or company rather's free cash flow goes from losing money to making money, is often associated with dramatic improvements in the stock price, in our experience. So in the case of Hain's 4090, this was actually a couple of days ago. I'm talking to you now after the close on Monday, and this was the price at the close on Friday, although I don't think it's much different. It may have been down 10 or 20 cents or something. So buy at 7% below the current market. So we're watching these 100 stocks throughout the day, looking for any one that may trade, that may decline down to our buy at price. And some days there are 2 or 3, and some weeks there are none. And I would say that on average, we have a buy a week or 2 buys a week, something like that. And but they tend to be highly concentrated during periods of particular market weakness. Here we're looking at Netflix over the decade 2010-2020. This was the top performing S&P 500 stock of the decade, up 37 times. And my point here is that in that time, where it was the top performing stock, it actually had significant declines 5 different times, ranging from 35% to 81%. Average decline 47%. And the point is that even the best companies, even the companies with the strongest growth characteristics, go through periods of price weakness. And that's why we've developed this artificial intelligence price recognition, or pattern recognition software, is to take advantage of those declines. So if you look at, this is not a particularly good example, but this red line here is the moving average. And if you bought the stock every time it touched that moving average or fell below it, those were obviously the high profit trades. And if you sold it whenever it reached an inordinate level above the red line, that those were in general terms good times to sell. Although there, down here you see a extended period where it traded at a large premium to the red line, and that was not a good time to sell. It continued to go up, but the software looks at all the different patterns over the previous 12 months, figures what repeats, tries to avoid inordinate risk, and it's willing to give up, that price rise from there to there in order to have the liquidity to purchase on the significant declines. So a lot of our subscribers totally ignore the sells. They just act on the buys. They're long-term investors in quality growth companies. And the software can be very valuable in terms of identifying those buy points. The actual back tests and the actual profitability per trade is significantly improved by taking advantage of the sells. But it's not 100%, as I said in here. For instance, holding rather than selling when it reached a significant premium would have been the thing to do. Okay, well, that's enough for now. It's probably actually a little too much. And thanks for your interest in the research. You can subscribe on our website. You can also subscribe to the YouTube channel, which helps a lot. And if you like the research, please click the like button. And if you have any questions or comments, you can leave them in the comment section below, or you can contact me directly using my contact information on the website. And thank you again for your interest. And if you're wondering what that snoring and etc. is in the background, that's my poor old dog Fozzie Bear, now at a very advanced age, and she doesn't like to leave my side, so she sleeps here all day long in the office, and she's become a champion snorer. So hope it wasn't too distracting.